The fiat will be devaluing and the debt will be devaluing, that you'll on the surface look number good, but you will never feel so poor. And that is the sleight of hand of inflation. It is the silent thief that compounds against you. And here's the tool that protects you. It's the gold market. Gold, gold, gold. But buying gold is a great way of protecting your finances, but they're going to come for taxes. They're going to come for confiscation, which is capital gains taxes. You may as well call it confiscation if you set the mark. They are devaluing your currency, that anything can be deemed to have a capital gain in nominal terms, not in real ones. It is a license to steal from the citizenry. This smells like a pre-Bolshevik revolution.
Americans are grappling with a staggering $35 trillion in debt, which continues to rise daily and prompts renewed interest in gold as a stable investment. The non-partisan Congressional Budget Office, CBO, projects that by next year, the U.S. national debt will surpass the nation's annual economic output for the first time since the immediate post-World War II era in 1946. This debt load is expected to climb even higher, reaching over 122% of GDP by 2034. Market sniper Francis Hunt delivers a riveting and profound analysis of what's coming. As Hunt aims to address the economic issues headed our way, he stresses that now is the time for action. He highlights how rising interest rates are squeezing American property markets, inflating mortgage costs, and fueling a doom loop of economic strain, a sign of a faltering monetary system. Hunt urges Americans to consider gold a crucial safeguard in these turbulent times. Gold prices reached record highs amid mounting uncertainty surrounding the upcoming election and the U.S. national debt. Year to date, gold futures have climbed over 32%, with a 38% increase in the past year, setting multiple all-time highs. Investors increasingly turn to gold as a safe haven, driven by geopolitical risks, including ongoing conflicts in the Middle East and Ukraine. Additional factors bolstering gold investments include uncertainty around U.S. economic policy post-election, the Federal Reserve's plans for rate cuts, and the long-term outlook of the nation's escalating debt. This situation stemmed largely from the 1964 to 1974 war, a decade-long conflict officially ending in 1974, and the pivotal event of 1971 when the dollar's peg to gold was removed. Hunt believes that this decoupling led to a significant gold rally and persistently high interest rates. In his view, these conditions set the stage for gold's rise amid an impending debt-based economic collapse. Ready to dive in? Before we do, take a moment to like and subscribe if you're enjoying the content. We're so close to hitting 1,000 subscribers, and with just 20% of viewers subscribed, every click counts.
You had low economic growth, you had filthy streets in New York with drug pushers and everything going down. It was seedy, it was dirty, it was everything throughout that, all as a result of that 1964 to 74 war, that 10-year war that only officially ended in 74. And of course, the event of 1971 that many people will know about when he removed the fix of the currency to gold. And as a result, you had a huge gold run as a result of that, and stubbornly high rates. So people that say gold won't go up on high rates, and stock market is super high priced. You've got Nvidia at 58 times sales. Scott McNeely in .com said, I never wanted 10 times sales. How can you value a company? We've got salaries to pay, tax to pay, and things to do. How can you even value us at 10 times? Well, we've got 58 times on Nvidia today. A super high valued stock market, particularly in that area. You are seeing the 60-40 die and stagnate. Both those asset classes will stagnate. Stubbornly high interest rates are going to cause those that are in property in America to stagnate. The ability for people to pay rents or to get finances got higher because the 30-year cost now to do mortgages is get higher. That's going to feed into inflation. That means it's a doom loop, essentially, but there's real opportunities to combat that. And you're looking at the canary in the gold mine saying, remember me, the money of millennia. We are talking about a failing monetary system, the fiat debt creation, where the one borrows into existence the other. They have an umbilical cord between them. You're going to see contraction in debt, and then you're going to see contraction in the currency, and it's going to be staircase. That's going to bring utter stagnation. Salaries aren't going up. That's why you're seeing the unions campaigning and getting higher than normal percentages because of living costs and living standards. And the only way people protect is to have the perfect tool for stagflation, and we're going to get a hyper stagflation, because the key different point from Volcker to Powell today is it was 30% debt to GDP way back then, and you're on 120 without your obligations to Medicare, Medicaid, and other welfare projects that some Boston professors have put through 600% GDP. This is going to be a stagnation era. Personally, if I were American, I'd consider leaving the country. People don't like that when I suggest that. But buying gold is a great way of protecting your finances. But they're going to come for taxes. They're going to come for confiscation. If you set the mark, they are devaluing your currency, that anything can be deemed to have a capital gain in nominal terms, not in real ones. It is a license to steal from the citizenry. This smells like a pre-Bolshevik revolution. Where you're having an asset stripping, and I just hope it ends there and doesn't lead to real citizenry accounts being hit as a result. So that's why gold's going up. We're in a debt-based collapse.
Historically, such a significant increase in real U.S. interest rates has correlated with an average 1.2% drop in gold prices. However, defying this negative relationship, gold prices have surged by 2.8% over the last 3 weeks of fall 2024. Since February, gold has consistently risen on all 9 instances, when TIPS yields climbed by 20 to 25 basis points. While lower rates still favor gold, which doesn't yield interest or dividends, higher rates no longer necessarily pressure bullion, notes an analysis by U.S. financial giant Bank of America. The bank maintains its $3,000 per ounce gold price target, citing heightened concerns around U.S. government funding needs and their effects on the Treasury market. According to Francis Hunt, gold's current price action signals the market's expectation of continued fiat devaluation. Hunt emphasizes that gold is the tool for the time, particularly in what he describes as a war on asset valuations. He believes governments will disguise the devaluation of currency and debt, causing people to feel poorer despite superficially high nominal values. Now let's redirect our attention to a video.
Government that you think is working for you, that has put you on an inflationary cycle that is now in the disorderly decline stage. And there's only really one defense for that. And that is physical things that you own outright that are known to intrinsically hold their value, that you yourself can control, because possession is still 9/10 of the law. Make them come and try get it out of your grubby little mitts. And that's a lot harder for them to do. That doesn't mean they won't try, but it's going to be a lot harder. They'll go for the easy pickings first. So I'm expecting wealth taxes on property. It'll probably start on the rich houses. It'll end up on all the houses. I'm expecting increases of taxation. They can't afford to provide the services that they've committed to. They don't have the money. They never put aside for it. I'm expecting anything. This is a monetary system collapse. So I'm actually short oil, long gold. For the people that are long general commodities, and oil will recover and it will go up as part of the long-term inflation, but short-term, the consumer and the retail is wrecked. It's a monetary system. You want the monetary commodities. It's a monetary system failure. Buy the tool for the time. I can bring a massive ass 16-wheeler monkey wrench for you to use while you're at dinner, but it's the wrong tool. If you're a truck driver and you've got a flat, it's the right tool. So the tool for the time in a monetary failing system is to be in the legacy or the original monetary system that has never failed and always will protect your net worth and your balance sheet. And I'm not talking 5% like this. I mean, I am grossly overweight and have been for a lengthy period in the precious metals market. Literally every tick of a cent is making a material difference in, my positioning in that space. And that's how it should be, because 5% will protect 5%. Listen, if they're telling you they're going to burn your house down, are you going to insure 5% of it? Why not over-insure it with 3 different people and at 125% of its value? Then buy a better house. They're telling you everything. This is a war. They've told you they're coming to burn your house down. This is war on your asset valuations, and they're going to play monkey business with the nominal value because the fiat will be devaluing and the debt will be devaluing, that you'll on the surface look number good, but you will never feel so poor. And that is the sleight of hand of inflation. It is the silent thief that compounds against you. And here's the tool that protects you. It's the gold market. Gold, gold, gold. The traditional story you're given is that rates are bad for gold. This is not traditional times. What people say, oh, many traders confused, puzzled by gold going up in this environment, rates and all of these narratives, puzzled. There's nothing puzzling about this. You have a death of an existing fiat and debt borrow into existence. They go together like an umbilical cord. They will contract in staircases. First, the currency devalues, the debt devalues. They've taken turns on it. That'll depend on the monetary policy. But the alternatives to these reserve assets that are no longer showing themselves to be risk-free reserve assets or paying meaningful yields against a much higher inflation number is that you buy something that retains value regardless in an accelerating fiat devaluing environment.
Historically, gold has proven to be a reliable store of value. A 2022 Wisdom Tree study highlighted gold's long-term resilience, describing it as an excellent store of value. Yet, over shorter periods, its inflation-adjusted price can fluctuate significantly, making it less predictable as a short-term inflation hedge. For those seeking stability in uncertain markets, gold offers a versatile option. Whether through physical bullion or gold-related stocks, it serves as an alternative asset class that can help cushion market downturns. While it may not fully replace traditional assets for long-term growth, gold remains a valuable addition to diversify and hedge against potential risks. In today's economic environment, do you prefer physical gold, gold stocks, or ETFs as a way to protect your wealth? Drop your comments below and let us know what you think. If you found this video helpful, please like it and subscribe for more. We're grateful to have you with us on this journey.